Well, thank you very much indeed, Stephen. I thought that was fascinating, actually, because we started off hearing from Guus about the enormous gulf between the buy side and the clearing members, and then he extended it to the CCPs. And then we heard from the sell side that they also have a huge number of demands and requirements of CCPs. I thought it was very interesting. I mean, the message surely to the central infrastructures is watch out, the customer expects, and the customer should always be right. And also I was very interested at the way the word trust appeared from both of you. I mean, this is a commodity that surely is in more need than ever in these post-crisis times. I want to involve you in questions. We've got another, let me quick calculate, 25 minutes. But first, let me just take up with you, Stephen. You were very passionate about this idea of access, that you must have equality of access to the central infrastructure, to the CCP, and this is enshrined in MIFIR, as we've come to call it now, the regulatory bit of MiFID II. But does this apply to all asset classes equally? Because there are differing layers of risk, are there not? I mean, are you equally comfortable with the thought of access in the case of OTC, exchange-traded derivatives, which obviously is the thrust of MiFIR, and then securities?
I'll pick up on your first observation first, that the customer's not happy and the customer's making complaints. I think that one of the problems we've had, and it's an inevitable economic reality, is that if you are a monopolist provider, you don't really believe you've got customers. You've just got people you take money from. And customer choice is what makes people have to listen to customer demand. In terms of open access to derivatives, absolutely, at one level. I think that it's unequivocally the position of AFME that there can be the use of CCPs to limit competition in the execution of very standardized derivatives. We've seen turquoise list derivatives that have failed to compete with very similar products, arguably fungible products elsewhere, because of the lack of access to the margin pool of the existing product. I should say at this point that I'm a director of turquoise, but keeping my AFME hat on, we would like to see competition in that space as well, and we do not believe that competition will happen in listed derivatives unless and until there's access to margin pools and access to the licenses for trading derivative contracts. It's a matter of public record that turquoise would have liked to have traded stocks futures, but had failed to get a license to trade stocks futures. They've been very clear that they would like to have had their futures access the same margin pool, their FTSE futures access the same margin pool as Life's FTSE futures, at which point they would become fungible and people could execute. I think it's been quite a laborious process of perhaps proving the obvious, which is that you cannot survive and you cannot compete in execution if the efficiencies that you're delivering are less than the efficiencies that you create in trying to do that. So just because you can execute more cheaply, you're not going to do it if the post-trade setup means that you've got costs that are far in excess of that.
And Guus, does this idea of competition, does that assuage you? Because I mean, in the evolution and birth of EMEA, you speaking for APG were very, very hostile at one point, essentially, because you saw it was actually going to increase your costs, it was going to lead to sort of lopsided treatment of your liability model. Are you happier now with the way things have worked out? I mean, putting in parentheses, of course, that you've got an exemption that goes on longer as well, but with this idea of competition in addressing the CCPs, the infrastructures, is that an answer to some of your worries and complaints as a customer?
Well, what we are concerned with is initially we advocated a more utility-styled mechanism in Europe, like you have in the US. That wasn't very realistic, to be honest, since the level playing field in Europe is not like that. The question is, do we have competition? On one hand, we don't like commercial organizations who will start compete on risk management. That's completely unacceptable for us. On the other hand, we have noticed, and I'm referring to the gap between buy and sell side again, we have noticed that not all, especially central platforms, but also some potential clear members, are not that susceptible for arguments of the buy side due to a certain lack of competition, which explicitly applies to the central platforms, because let's be honest, it's only a handful in Europe, and they're not used. They're only used to speak to their customers, which are the clearing members. And that's why we are now, for a while already, involved in tri-party conversations, central platforms and clearing members and buy side, in order to get this thing up and running. And again, if you refer to costs of the system, it's not so much the fees. It's the loss of yields we had to pay in the original plans. That's hurting us. It's not the fees as such.
Stephen, you want to say?
Yeah, I would just say, and bearing in mind that presumably or hopefully you are speaking to some of my colleagues about our ability to deliver your needs, and hopefully there are people explaining either the costs or the practical problems that are presented by doing that. I would just like to say that I would love to have your problems, which is speaking to multiple providers and explaining to them what it is I want, because we don't have that luxury. We have to face a single provider, and we are obliged by regulations to access every major market when executing business. If we're delivering best execution to our client, there is no way that we can say we're not going to trade on NYSE Euronext. It's a regulatory obligation, and if we do that, we're then presented with a CCP.
But it's my firm belief that interests are running parallel completely here.
Yes, I believe so.
The venues, the sell side and the buy side, but it's just a matter of getting the act together.
Yeah.
Any questions from the floor at this stage? Because if not, I will continue. Oh, sorry, John Tanner again, I think, from the London Stock Exchange. It's a tortuous navigation between these tables, isn't it?
It's really a question for Stephen, I think. That you talked about what should happen if a CCP goes bust. It's a discussion we have with people in the market from time to time, and the implication is that although you want to put all your business through one CCP, part of a group of interoperating network, but if that CCP goes bust and you have to switch to another one, you probably need to have a dormant membership of the other CCP. Most people we talk to at the moment don't seem to want to countenance the cost of doing that, and there isn't an effective way of doing it. Do you have a view on this? Winging
it slightly, I would imagine that it would be fairly straightforward for participants in the market to use other brokers who have got existing access to those CCPs and to do bilaterals with them and effectively access the CCP that way. If you can tell me that that's not the case, then it's back to the drawing board. But I can certainly see that we would not look to have a fully functioning CCP relationship as a fallback.
I don't know if there are any CCPs in the audience, but I mean, this does raise the whole, we've got a booming mic here, but this does raise the whole issue also of the amount of money that is available for investment in these infrastructures, isn't it? Because I mean, what's always struck me is that when you look at the money that is put up for some of these headline investments, it's incredibly small compared, for example, with the 400 million euros that we're going to hear this afternoon that the ECB has spent on T2S so far. And I just wonder if there isn't a problem here that, it's this sort of split between the back office mentality and the front office mentality, that the back office doesn't get the investment even in these times post-crisis, that the glamour of the front office, the salesman, come to expect. Is that a problem?
I think it's fair to say that the ability to deal with somewhat dysfunctional and accidental status quo has been the ability that's resulted in promotion in the back office, and perhaps not necessarily a striving desire to change that status quo. I think a lot of people have done very well and very good jobs of dealing with a somewhat suboptimal position. I do think that, as you say, the cost of entry into this market is fairly small now. It's, there are numbers bandied about, and perhaps there's people in the audience that can better tell us that what it costs to create a CCP, but it certainly would contrast quite interestingly with the price of a fully functioning one, and would raise questions about the anticipated competition that would be faced by those incumbents.
It brings us to the risk management side, doesn't it? I mean, the hardware or software, I'm technically totally ungifted on these things, but, thanks to Moore's law, the price has dropped dramatically, but the real cost is the expertise of the risk management.
I think that's what I was alluding to about we've got to where we've got to by people stepping up and creating large mainframe computers that required a lot of investment and a lot of people around them to work them, and they're now facing competition from a new generation of provider. The same has happened in the execution environment. When Chi-X established itself, it was using very new blade technology, and the London Stock Exchange was still operating in a mainframe. That was adequate when the London Stock Exchange had a monopoly on exchange-traded UK stocks. I would suggest, as a fairly direct result of that, the London Stock Exchange had to upgrade and invest in its technology. I think the logic would suggest that the same is true of CCPs.
But it's also the case that it's not only a matter, I think, between where to allocate the monies within the sell side. Right now, the platforms, the CCPs are owned by sell side exclusively. Why should you keep it like that? If you want money, the money is here. And you solve your governance problem at the same time.
I'm not sure that all the major CCPs are owned by banks.
No, not all the ones, but some of them.
I suggest that perhaps the more pro-competition ones, the ones that are prepared to have a faith in their own ability to provide product and to compete, are the ones that are owned by banks.
But sure, this is where skin in the game is terribly important, isn't it? I mean,
I think that I think that was probably talking to a different issue.
It's funny to a certain extent. Of course, we push for changes to the structure of it, and of course, we run into the argument to say, well, that's all very costly. To which we reply,
so what?
So what? We have the money.
We'll pay.
No, you cannot participate. Why not? I don't get that.
And yet, you're mandatorily, increasingly forced.
I'm pushed into this system, and I don't control it. Yet.
Yet we were hearing roughly similar things from you, weren't we? I mean,
we've seen very similar things. The reason that the banks built Turquoise was to catalyse competition. Sure. And it has to be said that I can speak, having been involved with that project from its initiation, that at no time was it about getting a direct return on the investment, about the asset. It was always seen as a way of lowering costs. And I'm delighted to say that the subsequent reduction in fees that we've seen has rewarded our investment many, many times over, and that's an annuity.
That's right.
I mean, we've been talking about fees, we've been talking about costs, we've been talking about risk management, but I mean, just looking at this helpful list of questions here behind us, there's another one that throws up the idea of other services that you might want from these infrastructures. I mean, here it says reporting, regulatory and legal. Is that a way of perhaps squaring the circle to make the user and the buy side and sell side both more content with the structures that you're dealing with? Is there more that can be extracted that can be beneficial? I mean, I suppose data, I mean, of a useful nature, it depends how you access that.
Yeah, absolutely. I think if you're going to ask people to compete, you've got to allow them to innovate. And these type of ancillary services where there's data and ability to add value to the process are the sort of things that are going to make you successful in the marketplace. If we can have one connection to somewhere that delivers what previously would have had to have multiple connections, multiple relationships with, then clearly we're going to go for that streamlining.
And it's certainly the willingness. Some of the clearing members are very good in informing everybody about the latest state of affairs, connecting people to each other, go to the CCP together, etc. Others are less. We of course that's cost as well, and but we really appreciate that. That's definitely a service. On the other hand, if you talk about service in general, a clearing member is not a prime broker. We are a bit concerned as well that you may offer conflicting services. So that's of course the other.
Could you elaborate on that a little bit? I mean, what part?
Well, of course, perhaps there's also an element of Chinese walls, but as a pension fund, you don't need credit lines. And that makes us a very special client, because we do have the money. We don't need a credit line. So you see sometimes that clearing members are struggling with that concept, because that's how their revenue model is built. It's not more on the credit than on the clearing service SEC. I'm not saying that applies to all of them, but some.
And would these concerns be addressed by unbundling? I mean, it sounds like what you're concerned about is receiving a bundled service where some of the elements that are in that implicitly you're paying for are actually of no value to you. And therefore you would...
Yes, but also the whole pricing model. So some of them have a pricing model which is built on the credit. It's not something that really applies
adapted to the new
I
environment.
think there's a lot of reporting. Because a lot of these services, to be honest, to say something wild again, is something we could do ourselves. But not so the reporting, for sure not. We don't want to go there.
When you talk about unbundling and this sort of thing, I mean, it's reminiscent of the code of conduct agenda, isn't it? That faded away, if you like, as a result of the crisis and other priorities. But in general, I mean, it is a plea for transparency, and presumably the access requirements that we see in EMEA, the access requirements that are aspired to in MIFIR, will also lead to greater transparency, because that will lead to the present vertical structures, the integrated structures that are silos, having to start breaking that silo down, or is that idealistic?
No, I don't think it's idealistic. I mean, I think that's very clearly the objective of the current drafting. As I say, I'm led to believe that there is some question over whether or not the current intent will prevail in the final legislation. I don't think the Code of Conduct failed, sort of, as you suggested, disappeared because of the crisis. I think it just became untenable to pretend that it was working, and that it was being adhered to. I was at the, I think it was called the MOG, was it? Yes, I was at the MOG when it was stated beyond any ambiguity that there was major providers that were not adhering to the Code of Conduct, and it caused nothing more than embarrassment It certainly didn't cause any retaliation or remediation of their behaviour. So I think that pretense has gone, and the legislators that still care about market resilience and market efficiency see that to deliver that in this space they need to legislate. Unfortunately, there are those that are just far more interested in sackcloth and ashes and continuing to bash the financial sector. It's not just the banks anymore, the asset managers are getting it as well. And I think there's an interesting conversation for you to have about liability-based investing for Professor Kay in the UK, because his damnation of the financial markets is running quite wide. At some point, the participants in the market need to stand up and say, yes, we, as a broad industry, have a lot of culpability, and sackcloth and ashes are appropriate, but we also continue to have an obligation to end users, and that obligation shouldn't be forgotten in our self-flagellation, because we should continue to strive for efficiency, and we should push for what is clearly not a well-functioning competitive market to be made better.
Now, we've still got a few minutes before lunch. Are there any questions from the audience on this exposition of... at the back, John Sericold of ICMA.
So John Sericold again, if I could just make a quick observation on John Tanner's point about the need to have backup arrangements in place. I think the fundamental idea is portability. So if you have posted margin and you have, particularly for the longer term derivatives contracts, I think one ought to be able to arrange things so that a CCP doesn't take on new trades and completes all its cash market trades on a 3-day view. But the crucial thing is portability of margin, so that the long-running positions with their associated margin are transferred from one CCP to another in the same way as it's foreseen that if a clearing member fails, the clearing member's clients ought to be able to transfer their segregated collateral, their segregated margin, to an alternative clearing member. And I realise that to solve that problem, you really have to get down into the weeds and into the detail of insolvency arrangements. But it seems to me for the market to work and for customers genuinely to have a choice, you have to have relatively low switching costs, either because you genuinely want to switch from one person to another for commercial reasons, or in the limiting case where your trusted partner has failed you comprehensively, and therefore you need to keep your positions open but through a different channel.
That was an observation.
Yeah, well, for us, it's definitely certain that we will always have backup clearers anyway, for sure.
Going back to John's question and Tanner's question, well, I think the obvious route is to have an alternative GCM rather than redundant membership available to you. But what John Sericold raises is a very good point around standardization, and I think that broadly Deutsche Bank sees standardization as one of the key efficiencies that we're failing to deliver across a large number of areas in our marketplace, be it market data or interfaces with CCPs. We've seen the enormous efficiencies delivered through the ubiquitous use of FIX in the execution space, but something similar in post-trade would dramatically reduce that cost of switching, and it would alleviate a lot of the pressures and stickiness and inefficiencies in the post-trade, and indeed in market data, where at the moment you've essentially got a different protocol for every execution venue, and you're trying to consolidate that data back into one place. It's a nonsense.
We'd be in a happier world if the Giovannini barriers had actually fallen, but they're still there mainly. Just quickly looking at my watch, I see we've just crept over the beginning of lunch, so thank you both very much indeed for shedding light on the buy and sell sides, and thank you too for your attention. And this brings to an end the morning session, so thank you very much.